Hi, folks. Dan Bird here with the daily scan for Tuesday, December the 10th, the day before the CPI number tomorrow morning, which should be very interesting. It might be a catalyst for the market to go one way or the other. Hopefully, it will go up, but who knows? Before I get started, today is Tuesday, so it's Technical Tuesday. I'm going to talk about a technical indicator or technical analysis. So we're not going to talk too much about the daily scan, but we will talk a little bit about a couple of stocks. The topic today, one particular subscriber said that they typically use trend lines instead of moving averages, and they noticed that I mostly use moving averages. I actually use both, but I thought it would be a good topic to talk about and just talk about the difference between trend lines and moving averages and how you can use one or the other, or more appropriately use them both in conjunction. So that's the topic for today. So the disclaimer, first of all, I am not a financial advisor. I do not make recommendations on what stocks to buy or when to buy them. You need to understand your own risk profile and your trading style. Nothing that I say constitutes financial, legal, or professional advice. This is for educational purposes only, and you should do your own due diligence. And if you do want to get involved with a financial advisor, you could go to this website right here and look them up and make sure that they are reputable. So let's first jump to the home page and look at the market bias, which ticked down slightly again today. So it was an interesting day, actually. Most of the major indexes were flat or down. We'll look at each one. The one that I was really watching was small caps, the Russell 2000. We'll look at that in a second. So here's the S&P continues moving lower, going back toward the support line, and you can see the 21-day moving average is right there. I'll talk about that in a minute as well. So there's the 21-day and the support line. Again, right now, it ended at the low of the day, so not a good sign. It means it could continue to go lower tomorrow. However, CPI is going to have a big impact on what this does. If it comes in higher, especially higher than expected, then that could cause the market to sell off significantly, maybe down to the 50-day moving average down here, which is 5,900. Right now, we're at a little over 6,000. So that's the S&P, the NASDAQ right here. Also sold off today, heading towards that support line. We'll see what happens if it gets there, if it keeps continuing. Tomorrow is going to tell people, tomorrow will make the difference. The Dow sold off more right at the 21 now. So below the support line, right at the 21-day moving average. That's a very key area right now for the Dow. And finally, of course, Bitcoin. How does that look? Bitcoin today, I haven't looked at any of these, by the way, yet today. Bitcoin didn't do much, hardly even 1%, down slightly, but not really by very much. So sitting right on his 21-day moving average. That's where it seems to be bouncing right there. But it doesn't seem to want to move much. It's just going sideways at this point. So we'll see what happens. Out of curiosity, let's look at the dollar, which is this one right in the middle. The dollar went up, ticked up slightly, again, right at the 21-day moving average, and started to tick up. Gold went up a little bit. Bonds went down a little bit. Dollar went up a little bit. 10-year yield went up slightly. Really, 10-year yield is flat, which is kind of what I'm expecting. I'm expecting it to be flat. Actually, at the Money Show last week, a few people said that they were expecting the 10-year to be down close to 3% next year. So that was an interesting prediction. We'll see if that happens. All right, so let's take a look real quick at, first off, let's look at the 10-minute charts for today. Look at the aggressive sectors first. Let me bring this in a little bit. There you can see the sell-off. So Monday went down. Tuesday we started higher but went down. So we're now below last Monday's open. So market continues to go lower. Technology is lower. Financials are flat. Discretionary is flat. Communication service, interestingly, is up. But that's where Google is. And Google actually had a great day today. Google's the only one left in our daily scan, by the way. Industrials are pretty flat for the day. And then if we look at the defensive sectors, healthcare up slightly. This vertical blue line is Monday's open. So we're talking about just since Monday, but last week it actually is down from last week. So staples are up a little bit. These are defensive sectors, by the way. Energy is flat, utilities pretty much flat, and materials down slightly. So the whole market looks like it's just trending down. We'll see if CPI saves it tomorrow or if it just continues to go. Out of curiosity, I want to look at the VIX. I think the VIX ticked up slightly today. Yeah, just kind of curving upwards right there. So you can see it. It's still well below 17. It's at about 14 right now, which is very calm, very little volatility, and really the VIX looks 30 days ahead. So it's basically saying that it's not too concerned about the market right now. So let's hope that that continues and it doesn't start to tick higher from here. 12-month rate of change also, you can see, is down. It has not broken that trend line. There's a trend line. So we're going to talk about trend lines here in a minute. And you can see I put them on the chart sometimes. There's a trend line right there for the 12-month rate of change. All right. Now let's take a look at a couple of stocks. One that a subscriber asked me about, and I didn't get to it, but I'm going to look at it today. And I have not looked at this yet, but it's Honest. Honest is just Jessica Alba's company, the Honest company, and it had a great run. So it went from $4, doubled up to $8. Right now, it's just moving sideways. The momentum is down. It's right near its 21-day moving average. So, and the accumulation distribution is moving lower. And money flow, short-term money flow is negative, but the long-term money flow is still above zero, still positive. So this is not really too concerning, other than the volume today was pretty high on this down day. And I noticed that on a number of areas today. So that's a bit concerning. But the Honest company actually has done really well. It's consolidating right now. Let's hope that it keeps consolidating. And if it does, it might have a chance to start trending higher if the market turns around and starts to go higher. Okay, so the next thing I want to do is talk about the Technical Tuesday. And the topic for today is trend lines versus moving averages. And I'm going to start this with some slides. So here's Technical Tuesday, trend lines and moving averages. Which one is better? Well, we're going to find out. All right, first, a few nuggets from John Carter from last week at the Money Show. And these are pretty interesting nuggets, actually. So first he said the market is designed to take money from the impatient and transfer it to the patient. I thought that was a great line. And I mean, there's lots of times I know that I've made that mistake. And really, all of this is a learning process for everybody, including me. And some of the things that he said, I realize that I'm doing wrong. So I need to make changes too. We'll talk about that more when we talk about the daily scan tomorrow. But you'll see here in a minute. But the market's designed to take money from the impatient and transfer it to the patient. So keep that in mind. The next one is the simplest strategy is to just wait for the 21 EMA. And I cannot tell you how many times he said that. Just wait for the 21. And he does that all the time. He says he will not jump into anything until it's back to the 21 EMA. Either it's pulled back and bouncing off of it, or it's below it and coming up and crossing to the north of it. But the 21 moving A for him is the key. Next, 3 reasons why traders don't make money. And this is something that he learned from one of his mentors. First reason, overtrading. And I've seen lots of traders that overtrade. They buy lots of different stocks. They try to manage 60 stocks at one time. I have no idea how somebody could do that. but they try to buy things and hopefully hope that one of them will really go up, and usually a bunch of them go down. And I just don't know how you can really make a lot of money trading that often. And it's not just buying lots of different stocks, it's also trading too much. So sometimes when things start to go against you, and I talked about it yesterday in the YouTube video about a number of stocks that had gone really high, had gone up, they've been on the top 10 list, and they were the ones that were being sold off yesterday. So sometimes when things go against you, the best thing to do is just to move to the sidelines and wait it out. Don't do anything. Next was buying with market orders. So this is the second mistake. This was given to him by one of his mentors who had been in the market for a long time, been working with hedge funds. And she said that new traders, when they come in, and even traders that have been there for a while, they buy using market orders, and they usually end up getting bad prices when that happens. So again, it goes back to the one at the top. Market is designed to take money from the impatient. Market orders are usually for people that are impatient. So limit orders are better if you want to get into something and you think it's at a good point. Rather than use a market order, use a limit order, but set it pretty close to the price, and it probably will get taken. So that was interesting. Now the next one is one that I am guilty of, and that is setting stops too tight. We'll talk about this more tomorrow. But I know I do this. I really should keep my stops a little further away, especially in the beginning. But this is one where sometimes you get stopped out and the stock continues to go higher. And I think you all have seen that as we've been doing the daily scan. And that's okay. It's okay that that's happened. The important thing is to learn and correct things in the future. And that's the whole point of the worksheet that I created that is available on the website to help you have a way to document all of your trades to see what's working and what's not working. All right, the next slide I want to talk about is really important. This was created by Richard Wyckoff back in the early 1900s. And this is called the price cycle, Wyckoff price cycle. This is the way markets move, and not just the stock market, but markets in general. This is how they move. This is basically is a reflection of market psychology. So there's an accumulation phase right through here, and prices go up and down in that phase, but pretty much stay in a sideways trend. So that's a sideways channel. So those right there are trend lines. So you can see the trend lines. And then this one here is really interesting. This is something that Dr. David Paul always talked about as well. There is a video about Dr. David Paul on the website. It's kind of buried, so you have to work a little bit to find it, but it is amazing. Unfortunately, he passed away last year, but he is a fantastic trader and someone I learned a lot from. But what he said with the spring is that the accumulation phase will go sideways, and then all of a sudden it will actually go below the trend line. And this is designed to take out the stops, usually from retail traders that have their stops set down here. Again, going back to setting your stops too tight. And then it just takes off from there. So that's called the spring. And then it goes up. So you can see it doesn't go straight up. You can see what I've always said, higher highs and higher lows. All the way up, that's the markup phase. And then it gets to another consolidation phase, usually near the top of the market. That's the distribution phase, where it goes sideways again. And then there's another spring, goes up and takes people out that have orders up here, and then starts to move down. And again, down doesn't go in a straight line, goes down and up, but lower lows and lower highs. That's the markdown phase. So that's how the market typically operates. So keep that in mind as we look at a couple of charts here and see if you can recognize this pattern in some of the charts. Next, I want to talk about moving averages. Moving averages is simply a technical analysis tool. You can find it on just about every platform. It smooths out the price data. They're technical indicators to see the average price movement over a period. There's simple, weighted, and exponential moving averages. I use the simple and exponential, and I'll explain why and how I use them. Simple moving average basically just calculates the average price over a specified period, while the weighted moving average gives more weight to present data. That's what the EMA, the exponential, does as well. And I like the EMA a little bit better. The rate of decrease between one price and its preceding price is not consistent, but exponential. So it really puts a lot more weight on the last few days or the last few weeks, whatever period you're trading in, and will show movement earlier in those shorter time frames. Limitations, it's a lagging indicator. Always remember that. Moving averages by definition are lagging. It can't create a moving average until it has a price. So it's constantly using past prices. If you want a moving average that's almost exactly the same as the price, then a 1-day moving average will change every day. So it will look almost like the price, but that's not usually too helpful. So we use a number of different ones: 5 EMA, 21 EMA, 50 SMA, simple moving average, and the 200 simple. Those are the 4 that I like to use. So the limitation is during fast moving market conditions, moving averages may signal an entry or exit too late. False signals in sideways or choppy markets, especially, moving averages can produce numerous false signals because they are lagging. So you have to keep that in mind. If you notice that the market is starting to move sideways, if it's in one of those areas, either accumulation or distribution at the top or the bottom, the moving averages will give false signals, and you have to look at other things. And then oversimplification, relying too much and ignoring important factors like volume, market sentiment, as well as economic and financial indicators. So something that I say all the time, you have to look at everything. Don't just rely on one particular indicator. Trend lines. What is a trend line? It's easily recognizable lines that traders draw on charts. And when I show you the charts here in a minute, I want you to visualize where those trend lines are. And I think if we do just a couple, you're going to see them really quickly. The trend line is used to give the trader a good idea of the direction in which the investment value might move. Trend line is a line drawn over pivot highs or under pivot lows to show the prevailing direction of price. Trend lines indicate the best fit of some data using a single line or curve. Single trend line can be applied to a chart to give a clearer picture of the trend, can be applied to the highs and the lows. Time period being analyzed and the exact points used to create a trend line vary from trader to trader. So some people like weekly charts if they're longer term, daily charts if you're a swing trader trading for a couple of weeks or a month or so. And then a day trader might use trend lines on minute charts. Limitations, they have limitations in all tools, sometimes last for a long time, but eventually the price action will deviate enough that it needs to be updated. And that is very true. So trend lines you have to continually update as the data points change. And traders will use different data points, so they'll have different trend lines based on how they are seeing the chart. So some traders will use the lowest lows, others will use the closing prices. So you should be consistent on what you do. Trend lines applied on a smaller time frame can be volume sensitive as well. So especially around earnings, for instance, trend lines may or may not help you that much. So let's take a look at one. This is a moving average line. That's what it looks like. I don't know what exactly those are, but they look like possibly a 20 and a 200 maybe, or a 20 and a 50 maybe. Not sure what those lines are, but that's what moving average lines look like. So you can see the shorter one follows price more closely, and the longer one takes a lot more time for price to cross over. So you can see in this case right here, it actually crossed down right there, but it was very quick. So this moving average wouldn't have helped you too much. And then it crossed back above. So a lot of times with moving averages, you watch for the crossovers. So this doesn't actually confirm a downtrend until the faster one crossed over the slower one down here. And then it crossed back above it again right here. And this is what the subscriber said, that these are too noisy, that trend lines are better because moving averages are too noisy. And we're going to take a look at that in a minute. Now, where would the trend lines be on this particular chart? Now, that's a subjective comment, so everyone might have a different place for them. But one likely place is right there. So there's a trend line. Now, to create a trend line, you have to have at least 2 data points. So a trend line needs 2 data points to create that trend line. So you would not know where the trend line was until this started to move up right here. And then you could create a trend line right there that would extend out like this. So when it came back down and hit it, and went back up, then it confirms that the price is following the trend line. But look how quickly and then now you've got 3 points, 3 touches for the trend line. But then look how quickly it broke through the trend line, and now the trend is broken. So it's no longer moving higher once it breaks through. But that's a much sooner point than waiting for the moving average to cross. So from that perspective, trend lines look pretty good. Now, what about the trend lines themselves? This is the downtrend too. So as it starts to move down, you've got 2 data points up here. So this trend line could have been drawn right there, and then it touched the trend line almost exactly, created a shooting star candle, which often is a reversal, and then it headed back lower. So once you're out up here, when it crossed to the downside, now you're looking for a downtrend. Got 2 points right here you can connect, and now it went down, came back up, and hit that, and this would be a good place to short because it gets rejected right there. So that's how to use trend lines. Let's look at the trend lines themselves. So here's what a trend line looks like, but trend lines can be drawn different ways. So you could have drawn it this way if you only had these 2 data points. So when the price was right here in this time frame, you only had 2 data points, you might have drawn the trend line there. This is what I meant by you have to continually adjust the trend lines. Or you could have drawn it here if you had let it run a little bit longer out to here, and then it pulled back, went through the trend line. And now you might say, well, that uptrend is now over because it broke the trend line. However, you can see the trend line actually continued. So you have to continually update the trend lines to make sure you've got the right ones. All right, so that's it for moving averages, a definition of moving averages and trend lines. Let's go actually look at some. And I am going to go to this chart here to do this. Bring it in a little bit. So this is the S&P. And based on what I just showed you, can you identify where the trend lines are? So let's very quickly draw some trend lines in first. Let's start right up here. So there's one right there. I'm gonna make this blue and solid. So there's a trend line there, and you can probably see a trend line here across these lows. Now this trend line probably would have been drawn more like that and hit this one here for the second touch. Then it went back up, came back down, and hit right in that area. And they're not exact. You have to add anything in technical analysis is not the exact penny. It's somewhere in that neighborhood. That's the way you have to look at this. So right now we've got 2 trend lines like that, and you can see that it's hit 3 times on this one. So this is a pretty good upper trend line. It's being rejected right now. So the next question is it going to come down here like it did before and bounce higher? This is actually a bearish wedge. We're not going to talk about the patterns today, but this is a bearish wedge pattern, which normally exits to the downside. So these patterns usually go to the downside, but it doesn't mean it has to, and it doesn't mean it won't bounce right there, go back up, and then come back down again somewhere later on. But right now, that's what it looks like. So there's the S&P. Now, what would this look like if we added moving averages? So I'm going to add 3 moving averages. I'm going to add an exponential, 2 exponential moving averages, and 1 simple moving average. And what I like to do, and this is completely personal preference, what I like to do is use an exponential moving average for anything less than 50, and anything 50 or greater, I use the simple. Now, John Carter talked about this too. He uses exponential for everything, but he made a point of saying that doesn't mean you need to. You can use simple for everything if you want to, or you can mix them like I do. You just need to get used to your own method and be familiar with how it works. So there's the 5, 21, and 50. So now if we look at it, we're going to use the same time frame up here. You can see now that, and the way that I use the 21 is I look for the crossover on the 21. So that happened right there just before the 5 crossed over. So that right there is where, that's the warning sign for me, telling me that the trend has probably changed and is heading down. And then on the upside, it went above the 21 right here, starting to move higher again. But I don't limit it just to the moving averages. I also want to look at one other indicator at least, and that is the MACD, which is a moving average convergence divergence. So it's still moving averages, just a different way of looking at them. All right, so now we can see right here where these crossed over. It's been above zero, crossed over right there, the same point where the price went below the 21 right there. In fact, I'm going to just draw a vertical line right here where this crossed over. And you can see that the very next day is where the price crossed below the 21. But you can see down here it went below the zero line. This is the momentum, and this is the actual moving averages. So those are all confirming for me. Now, where did it go back up? So right here, this is where the momentum started to go positive again, right there. And you can see it actually went above the 21 right in that same area. So that would be the entry, the re-entry right there. Now, notice that in this period right here, using the trend lines, you would probably want to get in. You'd be getting in when it bounces off of here, but you wouldn't know for sure exactly where to get in other than you could put a trend line right across these tops to see where the downtrend has ended. All right, so using a trend line, you notice this is going down, so we're going to put it across these two tops. It gets extended down here, and notice where the price crossed back to the upside, where it broke the downtrend line and started moving higher. Exactly the same place as the moving average lines. So using both of these together is really the key. That's really the best way to do it. But you can do either one. You can do it either way. So here's the NASDAQ. I'm going to do this one real quick, and we're going to spend a little bit of time on one of the other ones. But I can start to see these patterns now just by glancing at the chart. This is another bearish wedge. So this one here could break out to the bottom again, or it could get down here and bounce higher. We don't know. Could be CPI that does that tomorrow. So that's right there is a trend line. And we'll wait for the moving averages. Here's XLK technology, same thing. Trend line right there. Bearish wedge right there, sitting right on it. So tomorrow is going to be really, really important for the technology group. If this can't hold, then it's probably heading much lower. It's probably going to be heading back down to the bottom, the support down here somewhere. So tomorrow's going to be really important. That CPI number is going to be crucially important tomorrow. Let's look at communication services. You can see this one has really had a nice run higher. This is where Google is. Now, if we draw a trend line like this, now I'm going to do, we're in stock charts. I'm going to do a Control D. Allows me to duplicate that line exactly the same width, and I'm just going to move it up. And now we have a channel. So that trend line right there is called a channel, and you can see how it just bounces back and forth between that channel. So if it does come down, we need to watch to see if it's going to bounce higher. And then if it does, it's probably going to go to near the top of the channel again. So this not only really tells you which direction it's going, but it also gives you some targets of where it might be headed to. So that's pretty nice. You start to see these things as well. Another one, and in this case, I'm going to use a Darvas box. So right over here, you can see there's a box right there. So it's bounced up and down and up and down. Instead of a diagonal channel like this, it's actually a sideways channel. So it's a consolidation. And normally when the consolidation happens after the stock has moved up, the stock many times will break out of it to the upside. This is how Nicholas Darvas made his money. He would find good stocks that were making a box like this. It's now actually called the Darvas box. And he would wait until it broke out to the upside, usually on high volume. So this volume bar right here be the price right here. That's probably where he would buy. And then he would let it go up and wait for another box. So in this case, he might have waited for this box right here and waited for the breakout right there. Buy some more, wait for that. When it broke out, buy more. And if it broke through the bottom of the box, he would sell everything. So then it moves up and might have created another little box right there. And he would buy more there, and he would keep doing that over and over. And that's how he made his money, millions of dollars. Okay, so next one I'm going to spend a little bit more time on, and this one is consumer discretionary. So can you see where the channel is? Can you see where the trend lines are? So first I'll draw some trend lines in. Clearly it looks like there's a trend line right there. But you had to wait for this touch before you can confirm that. So initially you might have drawn the trend line like this and then said, oh, it broke through it. So maybe that's it. Maybe that's the end of the uptrend, but you don't know for sure. And then when it didn't really go down any further than that, now you have a Darvas box. So now you've got a sideways move, and then you wait for this breakout right here to buy. So on a trend line like this, after seeing this, you probably would have been watching this downtrend. So you'd have a trend line like that, and you would have seen it break out right there. So you would put a buy order in and buy it right here. So there's your buy order right there. And you don't know what the trend line is yet. So it comes back and continues higher right there. So now you do have a trend line and it's going higher. So now you can add to your position right there. Then it goes up and goes sideways. And then now this diagonal trend line is no longer valid. So now you have to wait for another touch point. But in this case, it just continued to go up. So when it broke out of this sideways consolidation, or really you could call it a resistance line. So when it broke out of that resistance, you would put another order in over here, right there. All right, and then you can draw another trend line like that, because now it is heading higher. So you've got a trend line right there, and in this case, you actually have a channel. So it went up to the top right there. So this is just bouncing inside the channel until it either goes up to the top up here or breaks through the bottom. The trend is still intact. So that's where those would be. Now, what would this look like with moving averages? Well, let's add the 3 moving averages. Add an exponential, another exponential, a simple moving average. Make this one 5, make this one 21, leave that one 50. The 5 I like to make pink. I like to use the same colors every time on all my charts, so I recognize what they are. 50 is red, and then I will put a MACD down here, moving average convergence divergence, and I give it a little bit of height. And now let's go look at our chart. All right, so I can see here the downtrend has begun. This crossed over and it's heading down and went below 0. So when this black line goes below 0, it's confirming a downtrend. The momentum had already gone negative back here, but the price actually doesn't confirm the downtrend until it goes below 0 right there. But that's where that happens. So just like with the trend lines, I'm waiting for confirmation on the uptrend. So the first confirmation that I mentioned to you before was above the 21-day moving average. So you can see that that is, let me make this one green. So that was right over here, right there. almost exactly the same as the trend line, actually 1 day earlier than the trend line. And if you had actually waited for the 5 day to cross the 21 day, it would have been on exactly the same day as the trend line break, exactly the same day. So then it goes up, and now you're waiting to see where we might want to add more. And in this case, actually, I'm going to do this a little bit different. I'm going to use an arrow like this. So this one would have been right here. And this one would have been on exactly the same day. Again, you want it comes down, touches the 21 day, and then starts to move higher. So it actually went above the 21 day again 1 day earlier than the trend line. So that's where you would add. And then it goes up, and now you can see that it's pulled back right here. It actually pulled back right to the 21. And notice that the pink line never went below the 21 here, 5 EMA. It never went below the 21 here. So this is moving sideways. So now we're waiting for a breakout. And the breakout actually came right here where it went above the 21 right there. And if we look down below, we can follow this down to see what the MACD was doing at the same time. And for this one right here, the MACD had just gone positive for momentum. For this one right here, this is just for confirmation. MACD had just gone positive, and in fact, the lines had never crossed, and the lines now are above zero. So it confirms the uptrend, but there's the second add. The third one is right up here above the 21-day again, just like John Carter said. And in this case, it's actually negative. So in this case, the only confirming factor is that it's still above zero because the momentum is below zero. The momentum is negative, but it's going sideways. So that's what happens. And the 5-day never went below the 21. So this is giving us some confidence that that's probably a pretty good place to add some more. In this case, it's about a week before the trend line. And after that, we're just watching the whole thing go higher. So, and you can actually see the trend line here is almost following the 5 EMA. It's right in between the 5 and the 21. So again, you can use either trend lines or moving averages. But if you use moving averages, you have to really understand what they're doing. And the way I like to do it is I like to get in when the 5 crosses the 21. But I don't use that again. I then switch to the 21 staying above the 50, which actually happened right here, actually right where these two confirmations were, where the blue line went above the red. So once I get in on the pink going above the blue, the 5 going above the 21, then I start using the blue above the 50. And that keeps me in the trade much longer. So in this case, it's continuing to go up. So that's the difference between trend lines and moving averages. Hope that was helpful. Let me know if you have any questions or any comments. Please like and subscribe to the channel so I can keep this going if you think this is useful. Also, let me know of any other topics you would like for me to cover on the next Technical Tuesday, which will be next Tuesday. And let's see what happens the rest of the week. One last thing before I let you go is TNA. I want to look at TNA. Again, tomorrow is the CPI. TNA was really interesting. So it's starting to pull back here to the 21. It actually hit the 21 today. Earlier in the day, and most of the day, actually, almost the whole day until the last hour, it was actually above and actually had formed a hammer. And a subscriber actually sent me a note saying, "Do you think that's a hammer on the IWM or the TNA?" And I said, "It looks like one, but let's see if it holds into the close." And it didn't. It didn't hold. It actually fell apart right in the last hour of trading. And if we look at the 10-minute chart, you'll see it right there. There's the last hour right there. So it went down and then went up and stayed up almost the whole day. And then right about 3 o'clock, a little before 3 o'clock, it started selling off and just continued to sell off right into the close. So we don't know what's going to happen tomorrow, but and I think the reason this sold off is because traders don't want to be long this if something bad happens with CPI tomorrow. But that probably will be the catalyst that will move this one way or the other. And if the move is lower, then it could be, I mean, it could go all the way back down here to support down here, 42.50. And the whole market's going to sell off if that happens tomorrow. So you can see right there, the 21 is just getting ready to cross. This is actually where my daily scan would probably pick it up right there. Yeah, it would pick it up right there because it actually closed. Let's see, closed with 52.17, and the 21 is 52.30. Yes, this would have hit the bearish daily scan today. So this would have given a bearish signal on TNA or IWM on the Russell. So that's implying that it has more downside left rather than more upside. If you look at this on a 3-year chart, you can see that it's really been trying to move higher. But next week or two, in fact, next week is options expiration. And probably next Monday's video, I'm going to talk about Max Payne. We'll see what next week is going to bring with Max Payne. So stay tuned for that. Also, for those that are subscribers or anybody that subscribes between now and next week, I am doing a Zoom call that's open to all subscribers on Sunday the 15th at 2:30 Eastern time. And that's open to anybody that wants to join. Lots of people join and just listen in, which is fine. There's a few people that ask lots of questions, which is great because usually they ask the questions that the people that are quiet want to ask themselves. And then we'll look at anything you want. We'll go through the website. We'll talk about technical analysis, and we'll look at individual stocks. Basically, it's just open to anything that anyone wants to talk about. So thanks for joining. I put the recordings of that, by the way, on the website under webinars and newsletters. Those recordings are right here for all the monthly Zooms that I do. And there's also a number of educational technical analysis videos over here on the right-hand side too, which are actually really informative. So if you're interested, you can watch those too. All right, thanks everyone for joining, and please like and subscribe. And let's see if we can keep this going. Thanks a lot. Take care.